GDP numbers, first quarter of 2023, the consensus estimate was 1.9%. And I've been talking about the estimates for Q1 GDP for a while on this podcast. And what I've consistently said was that the estimates were too high and that I would take the under on the over-under when it comes to Q1 GDP. And I would have won if I had placed such a wager, because we did come in under, considerably under. The estimate for growth in Q1 was 1.1%. So way below the 1.9% that had been forecast, even further below the 2.6%, which was the quarter that ended 2022. So quarter over quarter, we have a big slowdown in GDP growth. And in fact, the 1.1% for Q1, that is the lowest number since Q2 of last year, which was minus 0.6. And that was the second quarter where we had those two back-to-back quarters of negative GDP that everybody said wasn't really a recession, even though technically it was. They said it wasn't. Well, the quarter that we just had, this is the worst one since then. And I think there's a very good chance that we will be back in a negative GDP quarter by this quarter. The second quarter that has already started, there's a good chance that this quarter will be negative, and so will the quarter that follows, which means we're back in a technical recession again if we have that, another 2 quarters of back-to-back falling GDP. Now, maybe they'll disregard that as well. I'm not really sure what it takes now for an official recession to be declared, but at some point they might have to do it. But I would argue that if we are in a recession again now, and if we were in one in the early part of 2022, I would argue that we've been in recession the whole time, that you could just throw out all these positive numbers as a bunch of noise. This is just one big recession that in fact is just the early stages of what we'll ultimately call a depression. But one of the worst parts about the numbers that were contained in the GDP was not that GDP was so weak, but that inflation was so strong. The GDP numbers disappointed on the low side, but the inflation numbers disappointed on the high side. So the personal consumption expenditure, that was up 4%. The expectation was to be up 3.7%. But what's more significant, I think, than the fact that it's above expectation, if you look at the fourth quarter of last year, the PCE was 3.9. So 4 is higher. Now, it's not a lot higher, but the direction is important because the Fed claims it's making progress on inflation. The PCE is its favorite way to measure it. And based on that, it's moving in the wrong direction. A whole quarter has gone by. We've had a couple of rate hikes. We're supposed to get another one, next month, starting on Monday in May. But despite these rate hikes, which are supposedly going to stop inflation, inflation is getting worse. And in fact, if you strip out food and energy, which I guess is the favorite part of the Fed's favorite part, because they always like to strip out food and energy, right? Look at the core. The core PCE was up 4.9 against expectations of up 4.7. But last quarter, Q4 of 2022, the core PCE was up 4.4. Now we're 50 basis points hotter in the first quarter of this year. That is a big deal. That is a big move in the wrong direction. So we got weakening economy because growth is slowing, and we got strengthening inflation because the PCE numbers are going up, not down. Quarter over quarter, slower growth, faster inflation. The worst of both worlds, stagflation. Now, the markets really didn't react much. In fact, the stock market went up. Gold didn't rally on this. In fact, gold's not even rallying tonight. One would have thought that based on the bankruptcy of First Republic announced Friday after the close, that Sunday night we'd be getting a rally in the price of gold. But you would be wrong if you thought that, because gold is down about $8. As I am recording this podcast, it's $19.82 per ounce. So, not too far away from 2000, and I don't expect it to fall much below 2000. And I think when people really start to think about this, they're going to buy gold. In fact, the data that came out was positive for gold. Again, it was hotter than expected inflation numbers, which the market somehow looks at as being bearish for gold because it means the Fed's going to stay higher for longer, but they still don't get it. It means the Fed is losing the battle against inflation. And in fact, it will surrender, inflation will win, and that is good for gold. For the reasons I stated earlier in the podcast, they built this house of cards. They're not going to let it collapse. They're going to do everything they can to try to keep it from collapsing, and that means more inflation. That is all they can do. The economy is addicted to inflation. We need more inflation, and the Fed is going to make sure that that's exactly what the economy gets. Even as it's pretending that it wants to fight inflation, it is preparing for another massive dose of inflation. The estimate, though, I want to point this out, for the Atlanta Fed now for Q2 is not a negative number. They're looking for 1.7. But a month or two ago, the Atlanta Fed was still looking for better than 3% for Q1, and they missed that by a mile at 1.1. So if they're looking for 1.7 now, there's a good chance that if they miss that by even less than they missed Q1, that it will be a negative number. But I also want to point out another number that a lot of people have been talking about, and they think that this shows that inflation is going away. And that is the contraction that is currently going on in M2, which is a broad measure of U.S. money supply. It's actually down now by 4.1% year over year. Now, that rarely happens in the United States. In fact, it hasn't happened during the lifetimes of just about anybody listening to my podcast. I mean, maybe there's a few people that are that old that are listening to my podcast. I don't know. But certainly in my lifetime, and I'm probably older than most of you, I haven't seen it. The last time we had a decline like this, or decline, was 1933. And I don't have to remind you what was going on during 1933. We were in the Great Depression. So the last time we had a contraction year-over-year money supply, we were in the Great Depression. Now I mentioned earlier that we may in fact be in another depression right now, and the fact that money supply is declining could be a good sign because that tends to happen